Good morning, friends. Welcome back to my channel, Smart Index Edge. I'm Nalinakshay Swami, recording this video for you people to learn. This is a learning video actually. In continuation with the previous two videos of Smart Money Index, I'm going to discuss what kind of proper setups you can identify using Smart Money Index. If you learn the smart money concept, it separates you from successful traders from the rest. You will become successful because it helps you to identify certain levels in advance when compared to others. I'm going to discuss skill of spotting the perfect trade setups. See, recognizing gold mine opportunities that have high chance of success. This type of setups identifying, it takes time, experience, and keen eye. So once you understand the concept, once you learn that, you should not trade blindly. You should understand thoroughly. If you do not understand and if you start doing haphazardly without understanding properly the concept, it will lead to costly mistake, and finally it will be resulting in losses. Now I'm going to break down key factors and rules to identify the optimal smart money concept setups. See, here I'm going to delve into specific trading scenarios. See, to get the proper setup, certain specific trading scenarios should be there. When you get that scenario, smart money traders, smart money concept traders get one step advantage above others. That's why I also see through the smart money concept, the Nifty levels or the any stock levels, I can anticipate one step ahead of all the people. So this is my effort that you should learn all these things and become smart traders. Here I'm going to discuss essential criteria and confluences. You should have criteria and also you should have confluence. Confluence should be there to identify the optimum setup. And I'm going to discuss about dynamic and static liquidity. That is very, very important in the market. Liquidity is very, very important because it gives momentum to the market. Next, you have to map the market structure, how to do it, and also how to avoid false reversal scenario. These are the things I'm going to discuss in this video. There are three essential criteria and confluences to look for market to identify optimum set. First, we need, I have just marked Ulta. The first and foremost thing is we need liquidity. Next is market structure. And third is time of trading and day and the week. I'm going to discuss time of trading during the day and the week. At what time there will be liquidity. During the day, there will be certain times will be there for the liquidity. And also I'm considering where the market is, on which day I'm trading. If I'm trading near the weekend, for example, on Friday, you should be careful because the liquidity starts drying up. You should be careful Because what happens when liquidity starts drying up, there will be wide difference between the bid and spread. So liquidity is the key factor for the identifying optimum trade setups. Liquidity. And what is liquidity? Market continuously seeks liquidity to absorb, to generate momentum. This liquidity is lifeline to the market. If there is no liquidity, no momentum. So I'm continuously talking about the liquidity because, see, we cannot provide liquidity in the market. Only big banks and big institutional investors can provide liquidity in the market. Once they get the liquidity, the momentum comes into the market. Our goal is to identify where this liquidity is hidden or it will start, how it is starting. So categorizing these two types of liquidity, I'm categorizing into one static liquidity and the dynamic liquidity. You should know one is static and one is dynamic liquidity. Static liquidity usually refers to specific zones in the market wherein pool of liquidity lying, such as stop loss or buy or sell orders. That is static liquidity. I'll come to that in detail. When a trader gets stopped out of a position, market absorbs liquidity. So when we place all the retailers put the stop losses, who is going to absorb the liquidity? That is the big institutional investors. They are going to absorb the liquidity. So we are giving liquidity to the big banks and institutional investors. I've talked about many times about this thing in all my videos about the liquidity. It is often speculated that large banks and funds often manipulate to creating fear. They will create a scenario. It should be, otherwise they cannot get liquidity. That deceive retailer trader believing they have clear understanding of price action. So I think this is the zone, this is the support, double bottom. All the retailers, they think double bottom, they keep stop loss and they will try to go long. So this scenario will be often created by the big banks. I'm just taking an example of double bottom. There will be many types of liquidity I'm going to discuss about. To survive and thrive as a profitable trader, it is crucial to identify static liquidity on the chart. See, you should identify where are the possible static liquidity on the price chart. Identifying the liquidity areas, it can be identifying in various areas on the price chart. Below equal lows, sometimes you might have seen market makes equal lows. If you place cursor on the chart, you will see equal lows, equal price levels, and equal highs also. They are equal price levels. Above equal, see, below equal lows and swing lows. There will be swing low also. Sometimes market starts rallying from a certain point that creating a swing low. Below that swing low, there will be liquidity. Or liquidity will be below equal lows. And also liquidity lies above equal highs and also swing highs. So these liquidity appear in this. These are the areas they will manipulate. How they manipulate, I'm going to discuss it. And also dynamic trend lines. You put trend lines, you might have seen many times when price falsely breaks out of the trend line and it snaps back. Those are the areas market has liquidity areas. So there will be static liquidity over there, stop loss hunting will be there. And channels. Sometimes now at present, Nifty is moving in a channel. Below, if it comes down below the channel, sometimes they deceive that there will be liquidity below the channel. They grab the liquidity and the market snaps up. So these are the areas we need to identify the liquidity where it is lying on the chart. And fourth one is order blocks. I've already discussed about the order blocks. Again, I'm going to discuss about it in detail. And also what happens in support and resistance levels. We think it is a support level, so we buy it, place stop order, market goes down. We think it is a resistance level and we sell it, market snaps back and takes out all your stop losses. And also we try to measure retracements by using the Fibonacci tools. So Fibonacci tools are also utilized as a liquidity areas. Sometimes we think it will only go 0.5%, 0.618%, and we place the stop loss order and try to go long, market goes below that to our surprise. That is how the liquidity area is placed in Fibonacci. So that's how so many times you might have seen that is happening in your trade. And also if you see on the daily candles, how many times you might have seen the daily candles, body and shadow, their liquidity lies beneath that. Liquidity lies above. You must be seeing shooting star form. To your surprise, market goes above that. So liquidity lies above that. So stop loss hunting will be there. Okay. We need to identify pattern which sweeps the liquidity. For example, we have identified a swing low or a resistance level or a support level. There we need to see whether there is any sweep of liquidity at that level. That is our point of interest. Are we going to see that? So we need to see absorption of the liquidity around certain supply and demand area. And we have to use liquidity as a confluence factor at supply and demand area before reaching our point of interest. I hope you understood. There is high probability that this area will be utilized as fuel for gaining momentum. Then only that is the presence of the, what we are going to identify is presence of the big money coming into the market. Only if you stay with the big money, you will be profitable. So you have to identify certain areas, certain point of interest like swing lows, swing highs, and resistance and support levels and supply and demand levels in advance. And we are looking for whether there is any liquidity sweep in that area. So we are going to gather information in advance, anticipate there must be liquidity sweep, wait for that, and then we will go along with the big money so that we will be profit. This is the idea of the smart money concept and smart money setups, identifying the smart money setups. To identify smart money setups, first you need to know where are the static liquidity lie. So I have discussed where the areas. So if you look at such areas in advance, and you can anticipate in advance what the price can do. Okay. I'm discussing first optimal trading setup. What sort of trading setup will be there? Here in this case, market coming down, it made a low and pulled back, creating a lower high. It could not make this high. So what happens here is it creates an order block over here. Order block in this area. I'm marked as unmitigated supply zone. See, this is a supply zone because market starts coming down, breaking below this low, creating the break of structure, BOS, lower low. So it has created a supply zone. So you should identify this type of supply zone. What happens is market from here after the setup should be like this. It should make a lower high, break of this structure, and it should make a lower. After that, market trends to move higher. It moves in a trendy fashion, creating an illusion that market is going for reverse. What happens is it goes and stops. It should stop below unmitigated. Unmitigated means this supply zone, it will not go to this area. It will stop just below this supply zone and it will make a double top. Double top or equal high. There is a spelling mistake I made there. You please bear with that. Equal high and creating a pool of liquidity. Why? That is a static liquidity. See, it makes a high, and what the retailers will think, it is a second time it is hitting, it is failing, so stop losses will be here. Stop loss pool will be in this area. And what happens is, sorry, I'll go back. So again, it goes down. Again, it breaks the lower low and it starts. See the momentum. See the momentum, how it is going in a trendy fashion. Here, this is unmitigated supply zone. It goes into the supply zone and again market starts coming down. This, when you see this type of setup, it should be like this. You can anticipate when the price comes to this area, there will be, you can anticipate further sell-off from this area. You can place an order over here with the stop loss above this area and then you can go for short in the market. Here, it traps all the traders, even the buyers as well as the sellers. So this setup will be created in the market. If you see that scenario, you can anticipate for a momentum. So market going back to the unmitigated supply zone and claiming for the liquidity. So picks up the static liquidity over here. This scenario will be created from the big players, big money, not going straight away into this supply zone, stopping below this area and reversing and going up to that area with a gust, and then you can anticipate for a sell-off from that. That is one setup. Another setup is you can see in the market this setup also. See, for example, market was coming down, it made a low and lower high. What did it do? It created one order block and it broke the structure and it is straight away going to the supply zone. It mitigates. In this area, supply zone, it is creating two supply zones. In the previous one, it created an unmitigated supply zone. Here in this area, it made a low break of structure. These are the important things for the setup, and lower low, and it went into the supply zone. You might have seen it gets rejected from that area and it makes a lower low, and one more order blocks or supply zone will be created in the market just below the mitigated supply zone. It will be unmitigated. So you will see such type of structures also. And also when it starts coming down, you will see fair value gap also. With the big candles, there will be fair value gaps will be noticed in the market. Fair value gaps are seen as an internal liquidity. And then